Since 1802, it's formed count them, three cup patterns, each time trying to break out above that 50, but then held back. Well, now the runner just crossed the finish line. After 45 years under a resistance level, silver sprinted past that $50 an ounce, and that's a very big deal. Now, some call for 400, but even that doesn't really reflect silver's true fundamental value, frankly, as sound money that holds your purchasing power intact. It'll express to that, but unlike paper dollars, quite honestly, silver is real, it's limited, it's trusted, and frankly, it's a diminishing asset since it gets used up in manufacturing. We started talking about this back in January as planes and boats and everything were loaded up with both physical gold and physical silver to come here to the U.S. So I just wanted to remind you that we began this conversation. This is when the trend began. It doesn't matter that it takes a minute to see it. But the reality is that it is a new reality for the physical markets and a huge problem potentially, well, we're watching it unfold right now in silver, for the Bank of England. Remember, we talked about the fact that all of this physical gold coming back into this country looked more like a repatriation, since typically in the U.S., all traders do are the contracts. But all of a sudden, somebody with very fat fingers were taking delivery. Well, we can see what happens when there is a short squeeze. Now, what's a short? A short is selling something that you do not have. You're counting on prices going down so that you can go in and buy it cheaper, and there's your gains in the middle. The Bank of England doesn't really have very much, if hardly any, gold for themselves, but they do store a lot of gold for other countries. Where did all that gold that they ship to the U.S. come from? And what happens when those countries make the choice to repatriate? Because what we're really seeing are the holdings that the Bank of England is actually reporting. And you can see that they are at extremely low levels. And even though there's been an attempt to refill those coffers, not really having it, is it? There is a problem that is brewing in the gold market. Again, we're experiencing that right now, and we'll talk more about that in the silver market.
Many central banks and vaulting institutions are acting differently. For example, a historically large volume of gold held offshore appears to be moving home. The traditional model, traders speculating via contracts, now sees individuals or entities insisting on physical delivery. When shorts, positions betting the price will drop, must deliver metal they don't own, a squeeze can erupt. Add to that vaults running low on holdings. The result, when physical claims become more assertive than paper promises, markets can be forced into new territory. The old safeguards may no longer hold.
But you can look and see here in this country that took in all of the physical gold, because here's the reality. If you don't hold it, you don't own it. Those ETF contracts, I'm going to show you in a second. I'm going to show you why. But look at the zoom up in the physical holding of the gold. And even though some of that leaked out of the system, no, it's pretty darn close to its high. There you go. What can I tell you? Because what we're looking at is gold makes a comeback. Guess what, guys? Gold never went away. Now, they don't want you to think of it as money, but this is sound money. When it is physical gold, this cannot be inflated away. And the central bankers are now holding more gold, or at least the same level as this whole fiat money, pure debt-based system experiment started out, going back to the 70s. And I love it when they refer back to a prior time because it tells you, it's one of the things anyway, that can tell you where we are in this trend cycle. Central banks are loading up because actually the same reason why you should be loading up. They want to retain their freedom and their choices. And this stuff doesn't do it. And as we're watching the test in this stuff, which this is just a representation of intangible Bitcoin or any of the cryptocurrencies that are designed to look like this, can you see they're not the same? And can you see that these are not outside of the system? Risk on, risk off. The test is unfolding now. But I want you to also notice that gold is the second highest held reserve asset. Really? US dollars still top it. But in 1971, when this experiment really kicked off, the dollars in the system and being used in global trade and being held in reserves, I should say, was 79%. Now, it's 46% now. Can you see that it's almost half being held, where gold is making a huge comeback in terms of central banks and has been actually since 2005 is when that shift occurred. 3 full years before the great financial crisis was noticed by the public. That's all very telling because who knows more about what's happening with the currencies than the central banks, for goodness sakes.
Look at how central bank reserve behavior is evolving. Bullish gold buying, increasing allocations away from fiat, and rising prominence of precious metals as sound money. According to the World Gold Council, central banks added 244 tons of gold in Q1 2025 alone. Gold's global reserve share has jumped, and it now rivals sovereign debt and fiat currency holdings. Wealth built on fiat may now resemble sand rather than rock. When central banks diversify into gold and away from pure credit or debt assets, the message is clear. The nature of money itself is under reconsideration.
And in fact, even the U.S. Treasuries being held in reserves, we know that's been declining for quite some time. And China and Japan, the biggest buyers, they've been liquidating or not buying as much or allowing runoff on their balance sheets, I should say, since 2013. And gold is about to overtake treasuries being held in reserve. Sound money, the flight to money that cannot be debased or inflated away. And we need it redeemable in our system, because if it is not redeemable, the public, they can say anything they want, just that like they have forever. Since especially 1971, when perception management had them manipulate the spot markets to keep you away from gold. You need it. Every single portfolio, I don't care what it consists of, needs a foundation of sound money. Otherwise, you've built your wealth on sand, not bedrock. The reality is that gold is the safest reserve asset that there is, because it is the only financial asset that runs zero counterparty risk. Everything else is credit. Everything else is counterparty risk. And when we look at what the central banks, the amount of gold that they say that they have, there are huge discrepancies. And they just don't declare it because they don't really want you to understand what's happening. They want you to feel comfortable in dollars, in the markets, in cryptocurrencies, in anything that gives them the power and control. Physical metals in your possession, both gold and silver, They don't have control of that. They have control of how you think about it. But even in the London vaults that shipped a tremendous amount of gold here to the U.S. at the beginning of the year, their gold reserves are still down substantially from where they were. What happens if enough people take delivery of those contracts? It's an explosion. You think $4,100 on the spot market in gold is a lot? It's chump change. It isn't even marginally close to the fundamental value, and it isn't even marginally close to the spot market value when the gold squeeze happens.
Most metal markets have long been governed by paper futures, contracts, speculators, warehouse receipts, and synthetic positions. But now, physical demand is asserting itself. When immediate delivery is valued more than a future promise, we talk about backwardation, a condition where the spot price exceeds futures, indicating tight supply and urgency. In silver especially, this shift suggests that price discovery is migrating from the paper markets to the real-world metal flows. When what you have becomes worth more than what you are promised, the system changes.
Since 1802, it's formed three cup patterns, each time trying to break out above that 50, but then held back. Well, now the runner just crossed the finish line. After 45 years under a resistance level, silver sprinted past that $50 an ounce, and that's a very big deal. Now, some call for 400, but even that doesn't really reflect silver's true fundamental value, frankly, as sound money that holds your purchasing power intact. It'll express to that. But unlike paper dollars, quite honestly, silver is real. It's limited. It's trusted. And frankly, it's a diminishing asset since it gets used up in manufacturing. And now that it's broken free, the race for the physical metal is on. Backwardation. We have to talk about this because what that means, very simply put, is that today's price, the spot market, is higher than the price in the future, which is unusual. It's like an inversion. In fact, it is like an inverted yield curve, and that is a signal that something unusual is happening. It's changing. Because normally futures cost more due to storage, insurance, financing, etc., etc.
Silver stands at the intersection of industry and money. On one side, it's used in solar panels, electric vehicles, electronics. On the other, it functions as a monetary metal. Shortages are now emerging as backwardation in silver picks up and warehouse stocks shrink. The spike in demand for prompt physical metal, the squeeze in delivery chains, and the melding of industrial and monetary use means silver is no longer just a secondary metal. When these forces combine, price trajectories can accelerate, and conventional valuations may look tame in hindsight.
That's called contago. But when people pay more to get silver now than later, that's a sign of urgency and scarcity. So big backwardation doesn't happen by accident. It's the market's way of flashing an SOS. It means something serious is happening beneath the surface. Frankly, something that can't and shouldn't be ignored. Because when spot leads and futures lag, it's a sign that paper pricing is losing control. And that's really the biggest part of the U.S. market. And it didn't just start, it started last January. And so backwardation shows up, especially when as large as silver's current $2.88 gap. That's huge. It's the market flashing red alert. And what is it saying? Demand for immediate metal has overwhelmed supply, and something big is shifting in how silver's price is being discovered. You know, the paper markets, that's a trading market. Yeah, well, that's shifting, and you better get on board. Because when the futures curve flips this hard, it usually means three things. Supply is under stress. Demand for physical silver is surging, and price discovery is breaking down. Now, we're talking about the paper price discovery, and frankly, that's true on every single asset. It hasn't been true supply and demand dynamics that have discovered price. It's been trading, because we need to make sure that banks make a profit. But more about that on another day, because any one of these three would matter.
We are in the early innings of a reset in how gold and silver are priced, stored, held, and traded. The old paradigm, paper contracts, deferred delivery, reliance on major vaults is under stress. Physical ownership, immediate delivery, decentralized storage, and the transparency of holdings are becoming more meaningful. Central banks are making it clear: durability, portability, non-counterparty risk matter. ETFs and paper proxies may offer convenience, but do they offer true ownership? If they don't, your portfolio is built on shifting sand. It's time to reconsider fundamentals, not just momentum, because the price rediscovery process is underway.
But all three together, let me tell you, that's a signal. A reset is coming in how silver and gold, frankly, are going to be priced. Buyers are paying extra for same-day delivery because they can't afford to wait, and they don't trust that the metal's going to be there when they're ready for it. So today's $2.88 backwardation gap, that's why it's a red alert. It shows that demand for immediate delivery has overwhelmed available supply. Well, who's buying? Well, you got to look at the industrial buyers. This is the point of the broadest base of buyer and why it's used in every single sector of the global economy. So we'll look at the industrial buyers: solar, EV, electronics, and more. They can't delay. They're searching for metal. Inventories are draining faster than mines can refill them, and pressure is building right across the board. LBMA's grade bars are scarce. Warehouses can't move metal fast enough. The logistics system is out of sync with demand, and premiums are rising for physical delivery. For decades, COMEX futures controlled silver's price. Paper trade suppressing real rallies because they can create as much silver and gold, for that matter, as they want to in these paper contracts if they never have to make delivery. But not anymore. Now that backwardation shows physical buyers are in charge. Real supply and demand are setting the price. And each dollar of backwardation marks a shift in power from paper speculation to physical reality. Perhaps that's why you're seeing such a big hit that just recently took place with both gold and silver, because a rising gold and silver price are an indication of a failing fiat currency. But silver is no longer just an industrial metal. It's behaving like, sound money. And the world is waking up. The squeeze is on. And the reset isn't coming. It's already begun. Now is the time to get physical metals, sound money, gold and silver back in the system. Must be redeemable. Must be.